We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, everyone. Hope you guys are having a great day. Yeah, I miss those intros, doing those intros. So now that I'm back at my original setup, we can kind of move forward from there. So sorry that the last live stream was moderately rushed. We had, I guess, over a 30-minute live stream, but this is also another chance to, I guess, go through it and ask questions if you guys have any questions on those topics. I see some questions already kind of came in. Thank you, Andrew. Yeah, my day is going good as well. How you gonna go live this late? Well, we'll see how long we go for, but just due to time constraints on work, etc., and extracurricular activities post work, this is the time that I have. TSN is still tasty. How many hot dogs are you crushing lately? I haven't had a hot dog in, I don't know, I think it's been well over a year. I want to say more than 2 years now since I've had a hot dog. Yeah. But yeah, let's go through some of the quick questions that I see that came in. Why are you getting wrecked on Dollar General? You want to let us know why your portfolio is pulling a Jeremy on that one. Yeah, well, Dollar General is not having a good day, but some of the stocks that we buy will not have good days or good years. There will be mistakes. There will be actual investment mistakes that is going to happen and will continue to happen. But I'm actually not saying that one is a mistake just yet, but although it could end up being one. What is your favorite exercise for staying fit? Good question, Brian. So actually my number one favorite exercise is the pull-up. I love doing pull-ups. So yeah, I incorporate pull-ups pretty much every day. I do, by the way, I don't like it, but I incorporate a portion of legs in every single workout. So I will have a dedicated leg day, and then I have leg workouts kind of scattered throughout the rest of the days as I do other workouts. I think legs is one of the muscle groups that you can train a little bit. You don't go crazy. You focus on leg day, right? That's when you'll go crazy. But I'll incorporate some lighter squats, jump squats. One of my favorite ones is the burpee pull-ups. So that one I'll do when on a day called either, I kind of make up the names, like Friday Fun Day or Sunday Fun Day, and I'll do burpee pull-ups. Those always get you going, and you lose breath. You really, if you're doing it right, you'll lose a lot of your breath. Okay, are the DG losses forcing anyone else to shop at DG secretly bullish? Yeah, that's the self-feeding loop. So that's how we'll do it. 3% position in DG and it's down 30%. Should I take it up 5%? Should I allocate to other ideas? Well, that's a little bit specific. Although I would say it does depend on your thoughts about Dollar General. I know that's like a cop-out answer, but it truly is. You got to consider how confident you are in the thesis of Dollar General, and consider also, map out, on your own a time frame of when you think it's going to work out, because technically having dead money in the portfolio is still a negative, right? You hold it for a certain amount of years and then it recovers in year 3 and 4. If that's not originally part of your thesis and you thought it was going to only recover in 1 or 2 years, maybe consider the aggressiveness of adding to another position, and then you kind of wait and see. There's no rush, what I call, in those positions. And maybe you were, and I would put myself in that category because, hindsight is 20/20. If you know that it's somehow going to fall 30% more, of course you wait. But we don't know those things in advance. But yeah, that's a kind of one chain of thoughts that you might want to consider, and then that could help you in your decision. Okay, so Fabio confirmed CrossFitter. No, I don't do CrossFit. Great question, by the way, Bank of America. So Bank of America long-term win. I've been taking a look at Bank of America. I've been eyeing some other banks. You guys saw from the last portfolio update. And by the way, you guys can ask whatever questions you want about the portfolio, because the last episode was rather short because I had other things to do. But if you guys have questions on that, you let me know and then we can address them. But yeah, Bank of America, is one of the banks I'm looking at. I'm looking still at some of the positions I did sell, but hey, we can still bring them back after that 30-day period, because I don't want to run afoul of writing those off. But in specific, Truist Financial, which was one that we sold, Wells Fargo. I'm trying to remember if I think of any other one, because I consolidated into US Bank Corp, which I'm really happy with so far. All right, so Fabio, Nvidia earnings fake. I need to know how many puts to buy next earnings. So that's not my main concern with Nvidia. I don't think they're fake per se. I know, okay, so there's recently a lot of discussion around Nvidia's earnings, because there's I forget the name of the other entity that people are saying contributed to that surprise beat, pretty much one for one. Like the amount that they ordered of Nvidia graphics cards, and the loan was apparently collateralized using the graphics cards from Nvidia. I'll be honest, I have not investigated too much, because Nvidia is not in my desired, let's say, investment realm right now. It's not in my crosshairs. I'm investing elsewhere, and I think I'm going to do a podcast episode. Yes, the podcasts are coming back because they are fun. And if you haven't followed me on Twitter, follow me on Twitter or X. I did give myself a shout out. I think I might have also given myself a shout out on YouTube, but I know I did on Twitter. A old episode on China, and I have a bunch of videos on China, by the way, on the channel. You guys can go on the YouTube channel and go back and watch them all if you so want. But I also have some podcast episodes on China, on like the political landscape within China. You can watch them on Spotify, etc. And I think a lot of that has aged really well. Again, because a lot of the information that people are freaking out about China today has been available for 5 or so years. It's just, I think there was a great point by, I think it was Peter Zeihan who said this, and it was, well, people were busy with their daily lives. There was all these other things going on in the West. And so just people weren't paying attention, and understandably so. But a lot of the information, like the demographic issues, that's really old issues. I think in some of my earliest videos on China, that was one of the points being addressed as, despite all of the other issues that I'm addressing, there are other structural issues within their population. And that wasn't even touching into the authoritarianism, but getting on that. Let's see here. Let me close this notification. Is Bank of America B of A? What are the first words that come to your head right away? Elemental Tomago, that's funny. I think Merrill comes to front and center because the brokerage that they have, but let's see here. You don't trash stocks, so don't do for video analysis. On the topic of semiconductors, could you quickly give your thoughts on TXN business? Most free cash flow going to shareholders, high ROIC and low capex. They're going to hit a wall. Texas Instruments, I don't really have a built-out thought on Texas Instruments. So Texas Instruments has been more like the blue chip bellwether within the semiconductor space. They have their hands in pretty much the whole offering space down the chain. They're not the most exciting business, but they're more steady Eddie. So I don't see an issue with current growth projections, but they're not. How do I put this? Because I don't want to give them disrespect. And let me actually refresh my mind on their current price, because I haven't looked at their stock price in well over like 4 or 5 months. Oh, okay, 163. Yeah, so they've kind of flattened out, because I remember throughout the COVID pandemic, they did rise along with other semiconductor plays, but they haven't actually corrected as much. They weren't as volatile as AMD here. I wouldn't say valuation is awful, but it's not something I'm too excited for. And Texas Instruments is not anyways in that vicinity of semiconductors that I'm excited about right now. So, but that, I know that's like a quick glance, because I do want to get to the topics, and given the time constraint, I want to make sure I get to the topics at hand, but I don't want to not address your comment. So I'd say that I don't think it's going to hit a wall per se, although the setup isn't favorable. There's a lot of other semiconductor businesses that are making that necessary investment now, and so their capex is elevated. And so as an investor, you kind of take that into consideration when you're doing your forward projections. Okay, let's see. For the comment, can we talk about the best stocks ever? Easy money. Oh, yeah, those are... Oh, the David Kelly guy. Yeah, I see him in the comments. Your topic at hand is not the Fed. Yeah, that's more of a joke because I think everyone's talking about the Fed and who actually gives a crap. Because most retail investors don't even understand. I think most retail investors are doing themselves a disservice by even caring about the Fed or investing on the Fed's decisions or the Fed's action. And more than likely they're going to do the wrong thing rather than the right thing. So. Is this a PayPal stream? So PayPal is one of the topics. So I'm going to be pretty much covering some of the topics we talk about in the analyst live streams. But we'll see if we can get to all of them today. TXN is a PayPal of semiconductors. No. Okay, but again, open questions on the portfolio you guys want to ask, you let me know, and then I'll answer them. Okay. Let's go to, I'm pulling up all the topics here. Because they're written down here. Okay. And the first one we're going to talk about is Realty Income. So Realty Income Delaware, ticker symbol O. All right. And I'll pull up it on the screen here so you guys, it actually came out with, Google was like, do you mean overstock? I was like, no. We're not talking about overstock. Okay, so we'll go here. All right, so yeah, Realty Income Delaware, actually all triple net lease REITs, if I'm being honest, if we go to any of them, they've come down quite nicely in the past 2 months or so. And now it's yielding close to 6%. It's on a relatively cheap valuation on an FFO basis, on a price to book, price to potential net asset value. So the discount's there. And so investors are now more interested than before. Realty Income, I've made videos on them in the past, and this is a retail fan favorite. Again, arguably deserved because it has outperformed quite nicely since it IPO'd back in, I think, 1994. And so the other component that retail investors really like is the monthly dividend payments that it pays out. But one thing to take note of is as of late in the past 5 or so years, it has underperformed the market quite drastically. So you can see on that 5-year, it is down 2.16%. So if you take a look at the 1 year, it's down 14.41%. Relative to other REITs, it had held up nicely in 2022. And then more recently, again, it's experienced that drop off. But again, all triple net lease. Sam, I see your super chat. Thank you for the super chat. Heart it there. So Lafufu stopped his VT v Lafufu stock tracker. Yes, that did happen. And then let me see if there are any other questions coming up. So how would you value the low margin business noodles? Elemental, you're funny. FedEx over Fed, exactly. Okay, so what's your favorite REIT right now? So I'll talk about that one because that will go into the conversation here that we're having. But yeah, Realty Income, it's a retail favorite. I would say the main issue, and I've addressed this in the past, again, I'm bringing content to light. The main problem with Realty Income is its size. It's a victim of its own success. The larger it gets, the more difficult it becomes to acquire creative deals. REITs make money on that spread that they can generate. And Realty Income, they do have a low cost of capital, granted. But getting those equally accretive deals here in and out into the future is going to become more and more difficult at that size. So nothing to say poorly on the management team. They're great. They have a great track record, but it's just going to be more and more difficult for them. And that's just the name of the game here. My favorite REIT right now is actually Agree Realty, which is ADC. And I've actually elected to sell Realty Income and liquidate the position, and then added more to my Agree Realty. And that's my new triple net lease play going forward. So Realty Income, we've been, in and out of it, or not in and out, but let's say larger, smaller position over the years. And now it's kind of time for us to part ways for now. There could be or will be a price point at which I think it's pretty attractive, but right now I'm going to take a pass on it. And so you'll probably see content from retail investors coming out on Realty Income. I can see that there's already this guy, whoever that guy's face is down there. Yeah, he I think has a YouTube channel, and it's it's YouTube. What do you expect? And what does it say? It's crash, time to buy, sell, or hold. Maybe talks about the dividend. A lot of the analysis you'll see on Realty Income is rather surface level. But I'll say that, if you know about triple net leases, they're fairly attractive. The retail or the real estate that Realty Income typically acquires, and this is probably another reason to be cautious about, is usually adaptable. So you think of like a Walgreens commercial property, you can adapt that property to a couple other use cases. In commercial real estate, we call it like the box property. So it's just a box. And we're not saying it's an actual box. We're saying it's the characteristics of that box make it so that you can change that box into something else. So let me give you an example of a non-box, right? Well, Vici Properties. I always talk about Vici Properties as having a double-edged sword advantage. So the benefit of something like Vici is your tenants can't really change. They can't go somewhere else. Caesar's Palace is Caesar's Palace. However, the drawback is, well, let's say Caesar's Palace goes bankrupt. Well, at that point, you have an issue because you have a dedicated property to a particular brand that has no one that can occupy that property. So Realty Income getting into this deal with the Bellagio, with Blackstone, that's something. Oh, maybe I should add that to the topics of today. Blackstone, Vanguard. I was going to do a video about that because I think the trend has been increasing. And even though I've addressed this in the past, I have videos on this in the past, I think it's good to just talk about it again. But yeah, I'll make it its own video. Okay, ever looked at WPC diversified? Yeah, but the problem with WPC is it's overly diversified, and I have. There are very few REITs that you can find that I haven't really taken a look at, but they exist, definitely exist. But yeah, WP Carey actually, they even have some properties that are private schools, and the land, and those are interesting leases because they're really long. They're over 20 years. And another benefit of WP Carey is its diversification. So it's not only diversified by asset class, it's also diversified by geography. Realty Income has also expanded into other geographies, but WP Carey has greater diversification. That can be a strength and a weakness. So the weakness for that is the real estate market typically prefers a concentration. I've said that in the past about WP Carey, so again, when I say that, I said it in the past, that means you can find it in older videos, but I have no problem readdressing points in live streams. So the benefit, again, of WP Carey is you do have a more diversified capital base, so more ways that they can raise capital. But and there's one other key component of WP Carey that you should note. WP Carey has been reducing their asset management business, which has, in effect, lowered their revenues in turn. And so the numbers don't look as good. But they've been switching over to a property-centric model. So they actually own the real estate that they're dealing with. And so now they're becoming an easier business to understand than before. While before they were a little bit weird to kind of analyze and model out. They're getting easier, but they're still pretty difficult when it comes to triple net lease. And triple net lease is considered easy, so it's like not that difficult. But they're getting better, and you still have to worry about the different asset classes that they do have. So keep that in mind. But yeah, let's see if there's any questions. I'm going to Thailand for a top tier investment. Fabio, thoughts on AMD? Their software stacks seem to be worse than Nvidia's. However, the space is shifting. Oh, like I see what you're saying. So B Ross, you're saying rising tide lifts all boats. Yeah, that's kind of a thought that's come across my mind. I will say that recently, the recent AMD release, that was from their quote unquote B team. The next release is going to be from their A team. So what we should see next round or next cycle of products, and that could be interesting what they come up with. But you have a point. So in their software stack, that's where they're lacking, and Nvidia's really dominated on that front. But you can make the argument there's just so much demand in that space right now. AMD could be a beneficiary by proxy, and so yeah, I can see that argument there. But I will say from NVIDIA's standpoint, because I didn't really finish off that point, I'm not looking to invest in NVIDIA. I think that NVIDIA is priced for perfect execution. And so the setup isn't very attractive to me. I see McBuda. That's a good joke. Fabio gets... Sam. Thank you for the super chat, Sam. Oh my gosh. All right. I don't know if I can even read that. But I guess everyone else can read it. So thank you, Sam, for the two New Zealand dollar super chat and for the comment. Made me laugh. Andrew, BlackRock is buying all the single family homes. All right. But anyways, going back to Agree Realty. So what are the components I like about Agree Realty over something like a Realty Income? They pay a monthly dividend, but that doesn't really matter or shouldn't matter too much. And they've also been on this downtrend. Agree Realty is family operated. The Agree family is still in control of the corporation. The CEO is Joey Agree, and he succeeds his father before him. The company under his stewardship has grown quite nicely. The performance has been pretty good, and I think that the setup in the future is for still strong performance. Not crazy, mouth-dropping performance, but strong enough that I consider it a position or a potential position, could get larger, in my portfolio. The benefit of it paying a monthly dividend, sure, that's cool, that's nice, but again, shouldn't be a reason for you to invest in it. What their strategy that I get behind is the focus on the high quality tenants. And above everything, that high quality tenant base, I think, is quite attractive. There's drawbacks and benefits, right? So you look at something like National Retail Properties, NNN, and you see that their tenant base tends to be a little bit less so on the quality side, but not terrible. The company that used to exist publicly that is no longer publicly traded is Store Capital. Some of you might remember them, some of you might not remember them. But Store Capital focused on that part of the economy that was just under investment grade, so not rated, but they did their own underwriting and they would determine that the tenant is worth it. They would have master lease agreements, so they had a lot of insight into the business or how that business was doing at that location. And so that's a benefit to Store Capital. They did well in their own right. That's sort of the opposite of what Agree Realty focuses on. And Agree Realty has also expanded their portfolio into land leases. Land leases can be a bit wonky. They, depending on the duration of the land lease, will trade very similar in terms of market valuation to that of a bond. If you want a company that is basically land leases galore, you have Safehold that used to be externally managed, is now internally managed. But if you see how Safehold trades, it trades very much like a long-term bond. So, it's pretty much the same thing. It's not the same thing, but it's pretty much in terms of how it's trading, because the underlying assets will rise and fall and fluctuate with long-term interest rates. So that being said, going back to ADC, they've structured it in a way that I think is quite favorable. The CEO is also very communicative, which I really enjoy. And I guess the strategy of focusing on the safer tenants can have the benefit of long-term growth and lower volatility, lower or higher occupancy rates over a longer period of time. And the cost of capital for something like Agree Realty is still quite low compared to peers, and that gives them a decent advantage. And I think there's plenty of room in commercial triple net lease real estate to consolidate. So Agree Realty is also, speaking of which, at the proper size. I think that's the sweet spot. So I invested back in Realty Income a while ago. My first shares ever of Realty Income were now, at this point, pretty long time, but the market cap was not 40 billion. That was after their big acquisition that now we have the behemoth of Realty Income. I don't think they can do many more of those acquisitions and keep the quality. And that was my main criticism. But Agree Realty is right there at that sweet spot. So I like the positioning here. Again, I don't really have, full crazy expectations on returns, as in I do think there's a strong likelihood that it could outperform, but I don't know to the extent of that outperformance. It really does depend on a couple of factors. So what kinds of properties and how quickly they're able to acquire those properties, and what the current debt market looks like at that given point in time. That could also contribute to the multiple that the market's willing to pay at a given point in time, which would, over that measured period, affect the returns. So can I look at Estee Lauder? Yeah, we can take a look at Estee Lauder. I'll try to remember that name, but I want to cover the topics. But yeah, Estee Lauder has also fallen. You have some super investors that are interested in it. And you also have some YouTubers that are interested in it because of super investors. And I think that's kind of poetic that, we have some inspired people on YouTube. All right. So just to make sure I cover the next topic. And so we're in order. The next one will be ORCL, so Oracle. And I'll give you my quick comments on Oracle because I think it's kind of interesting. It fits broadly with my theme here. And you might think, well, Oracle does fit in that investment theme. So I'll kind of give you guys up to date. One thing I do want to make sure. So if you guys don't know, this is my public updates on YouTube that I don't really post too much on YouTube anymore because of time constraints. Most of my efforts go towards, current career advances and then private content that I'll do with me and the other analysts. And one of the larger themes that you might have noticed or penciled out within my portfolio is, well, you have a lot of, hyperscaler plays. And yeah, that's, I'm not going to deny that. There's a lot of cloud service providers. The only one missing in there of the major ones is Oracle and Microsoft. But talking about Oracle here, the main issues I see with Oracle is the way they've structured their capital stack, being more specifically the amount of debt they've accumulated over the period of time. Now, part of that debt was accumulated off the top of my head. I remember they did an acquisition. The name starts with a C, not Cerence. Starts with a C. That they provided basically technology, service solutions, and IT to healthcare. Can't remember the name. I think it was like Cerence or no. Cerence is another company. Starts with a C. You'll probably look it up and you'll find it. But the acquisition, okay, lots of debt, and okay, what's the issue with that? Well, they have good amount of cash flows. I think projected cash flows will eventually get to over 30 billion in EBITDA. By late 2020s. So, moderate growth there. Strong growth. I'm being facetious. But the part of Oracle that has been a laggard has been their legacy licensing solutions. And I don't think they actually call it that, but let's call it that for the sake of the argument or the discussion. And the part that's exciting is the cloud business. So the cloud business and all that entails, and the prospects of AI and all that. So that's what's been, the market has rewarded, and year to date, Oracle is still up even after the drop, 34%. Prior to that drop, you did have, something respectable here, and you would have said it's in line with the broader or at the top end of the NASDAQ. Oh, Google's not grabbing. I'll just grab it from there, whatever. And it was up over 50% because it's not grabbing that, low bit at the left. Thank you, Dex. Cerner. It was escaping me, but Cerner. So the acquisition of Cerner contributed strongly to that debt. So, of course, their interest expense rose drastically, and I think they're sitting at close to 80 billion in debt. Again, still covered by the cash flows. Nothing crazy. I don't think it's a issue to be worried about bankruptcy or anything like that. But you have that growing cloud business, and you have that stagnant legacy business. So looking through that, you see that there is still something quite exciting here. You have very strong insider ownership with close or roughly 40 to 50%. I think it's closer to that 40% marker being owned by insiders. And the capital allocation strategy has been leaning on buybacks. And they do pay a dividend, but it's been leaning on buybacks. So it's been a buyback story, and they've taken on debt to do those buybacks. So we might have disagreements with management and how they're conducting themselves. In particular, I think, one thing we could say is I would have preferred less buybacks, more, okay, do your merger with Cerner, cool, but maybe we wouldn't have to take on as much debt otherwise. Now, granted, at the time of the acquisition, debt was pretty cheap, and the cost of their debt relative to historical levels or historical costs of debt for many businesses is pretty low. And they have a decent credit rating. So it's not, again, a danger. I'm more disagreements in optimization and introducing further risks into the future that I might say, well, did you really need to do that? Maybe they did, right? So I think that overall, Oracle does present an interesting opportunity here on the drop. I know that one of our analysts, I think, is going to be pitching it. I don't know. I'm not going to put a timetable for them. They'll decide when they're ready for it. But I do know that's in the works. And so my quick thoughts on Oracle is, it does fit more or less in my theme, in my broad concentration investment right now. But I don't think they're the best player. I think I have selected what I think are the best players in going forward into the future, minus Microsoft. I have not selected Microsoft, but I'm very confident in the ones that I have selected because I was able to get them at prices I really agreed with. Oracle hasn't made the cut thus far, but I don't want to diminish their position. They're very much a strong player. The returns here could be, they could be better if we get even more of a pullback, because the pullback here was disappointment on growth, disappointment on outlook, if I remembered, because it's been a couple days now. And I don't think that's too much of an issue. I think that, what the expectations were going into the earnings call were quite lofty, and going out of the earnings call, okay, they're analysts are disappointed or whatever. I don't think that the long-term story is really dinged here. Now, what you pay for the company, okay, well, that will dictate more or less what your what has to go right, what has to go wrong, okay? Because if you pay really lofty valuation and it's priced for a lot of successes and those successes don't come, well, yeah, don't be surprised when the performance isn't all to snuff. Christopher, yeah, basically how I'm getting in there. I'm talking around why I'm very bullish on Amazon. But yeah, I am very bullish on Amazon. Because if you guys remember, I think I need to do a video explaining the distinction, because I'm public on YouTube. I'll say it this way. I'll just cut to the chase on it. So when you guys see the portfolio updates on YouTube, that's the personal holdings, right? And so that I keep pretty much private, right? In terms of dollar figures, you get percentage allocation, and I do, as frequent as I can, updates. I explain why I bought, why I sold, okay? And then within the club, I provide the holding co portfolio, which is contributed to monthly. It follows the same modern strategy. What I mean by modern is that I have none of the legacy positions, although as the portfolio gets older, we're going to start calling some of them legacy positions. But it's relatively young portfolio, as in that portfolio, which it has its own entity, its own structure, started in 2021. And that one was more or less to have that, illustration. Hey, what would happen if the portfolio started over? And that one is shown in all its simple glory. And then you get the dollar figures the brokerage statements, the returns, etc. So what you've been probably noticing, and I don't know if you are seeing it or you aren't seeing it, Christopher, but you might have seen the massive allocation to Amazon, which the bag's out, but I feel like that's fine to share. So keep in mind, as the portfolio continues to get more and more contributions, because it is contributed to monthly, the capital that is able to be deployed is also growing. And so I'm always allocating to my current ideas. And so, of course, the legacy positions not being in there, I'm not going to buy legacy positions at whatever price. They have to be at a good price for me to consider it. It follows, again, the same modern strategy. So Meta still, the largest holding, and then Amazon has the second, but then you see there's a big discrepancy in Netflix. Well, that's because the holding co-portfolio was so small when I was buying Netflix overall. So it is what it is. What are my thoughts on a company called Salesforce? Well, I'll talk quickly about Salesforce because Fabio about to drop the value is what you pay for. Salesforce, I have to like it. It's a position of mine. I have, for full disclosure, and I don't like to talk about that too much, but for full disclosure, I do have pretty much in the entire position some contracts sold for December. And the reason why I chose December, and it's, I think the strike price is $295, but the reason why I chose December was because that's the time period where all of it turns into long-term capital gains. And $295 is a price I think I would be very happy at selling Salesforce. But yeah, no, overall, like Salesforce, the thesis played out. The thesis when I pitched it to the club, and when I think I also pitched it on YouTube. So actually, there is a public video for you guys to watch on YouTube where I give a summary of the thesis. Correct me if I'm wrong. My memory might be failing there, but I believe there is a public video, and it was posted, I think, in January. So a little bit of a delay between the club pitch and the public video, but more or less the same idea, that you will see cuts in spending, you'll see drive up in profits and cash flow. And that was management's plan, and you can see that kind of execute. Of course, you had the entire tech sector also rally. So you have, let's call it back to sector rotation, back to large cap tech, and then also execution on their strategy. The performance was, pretty good. And so you saw, again, QQQ's had a really strong year to date. If you guys can probably see on my Twitter, I don't know if I tweeted the smaller Capital Mindset Holdings portfolio, because that one's year to date's ridiculous. And I'll say it like this: the dollar amount in holistically is immaterial, but I know for a lot of people it would be a lot of money. But its existence is just to give status, banking status. And it has only 2 positions. And if I ever post it, I'll always be forward and honest and say, hey, this is a very immaterial portfolio. But the year to date is somewhere around like 130, 140%. I think at its peak it was 156% year to date. And the posting of those year-to-date pictures, I posted in the club, and I always say, like, oh, I'm totally memeing, by the way, because it's like a year-to-date bro portfolio. And so I just think I don't know, it's kind of funny. There is no long-term, there's only year-to-date. Yeah. So because, again, like 2022, basically, like the huge advantage of the portfolio's returns, which I think I got a comment in the last live stream. Someone asked if I could, or they asked what are the returns. I did post them on Twitter per the broker, by the way. So it's not just like my statement. I might post them on YouTube, the same photos. I have more updated photos because I shared with the club the returns ex Meta and the returns with Meta. The reason why I selected that time frame, removing Meta, and again, all per the broker, was because I wanted to highlight that, Meta was a great investment, yes, but there were other players that actually kicked in really well last year, and I don't want to do them a disservice. I make it sound like they have feelings, but maybe it's just, as one of the members said, it's like, the Fabio's Fabio's feelings are hurt because everyone's paying attention to only Meta. And well, I guess like that is the consequence of going so heavy into Meta. And so, of course, it's making a statement of confidence. But there were other investments last year, and excluding Meta, the performance was still double digits. And then Meta just boosted 2022's returns even more. I'll probably see if I post those on at least on Twitter, because I don't really like posting it too much on YouTube, but I might elect to because there's not really a reason not to. It's just kind of clicking buttons. So those will be posted on Twitter at some point. Again, it will be the performance including Meta, performance excluding Meta. And I'll even throw in, because it's technically not supposed to go public, because that is the holding co portfolio, which is for the club members. I will post that one as well, just the returns, because the club members are the ones who get the positions and stuff. So NOC versus LHX, what do you think make you want to build the position more versus what are actual red flags? Okay, great question, because Andre, I didn't get to your fully develop your answer that you deserved in the last stream. So L3 Harris, I'm not going to talk about the acquisition because we already talked about that. But for anyone who's curious, the acquisition airs at Rakuten, but I'm not going to get into that. So aside from me thinking that acquisition was favorable and how that positions themselves for the future, I do think that the valuation on L3 Harris is quite attractive here. The P ratio right there, according to Google, is not true. That's including some one-time expenses, etc. So the valuation or the multiple relative to peers is actually discounted. So L3 Harris is discounted to peers. You have NOC, which is typically trades at premium to peers, because if you look at the positioning of the businesses, NOC has a lot of what the government is going to be focusing on in the future, the obvious stuff, space. L3 Harris is traditionally more communications, radio frequency technology, and more like components that go into other larger projects for the military. Now, where they're positioning themselves into is they're going to be also a producer of rocket technology. Again, Airjet Rocketdyne acquisition. We got oh, Sam. Okay, anyways. I can't read those comments, Sam. But I know Sam's having a lot of fun there. So if you look at, and I'm surprised you didn't ask me about Raytheon Technologies, by the way, Andre. I would think you'd ask me about Raytheon, because Raytheon's the one that's recently, interestingly, punished and typically trades at a premium. But NOC is currently larger within my portfolio. I'll even tell you guys, I'll throw in the dollar figure. So the dollar figure in the holding co, which is the one that holds L3 right now, it's like nothing. I have like, what is it, two something in there. And NOC actually has no presence in the holding co, which is the ironic part. Has no presence in the holding co, but a presence in the personal holdings. So I think, and I am down on L3. L3. Well, I am down on L3, like 5%, but I'm down on NOC a little bit. So what's my rationale? Because the allocation, dollar figure and percentage total is definitely in favor of NOC. I thought the recent drop on NOC was, okay, well, yeah, there are some concerns and issues, but longer term, nothing's really changed along with the story. And I do think that NOC will continue to trade at an elevated premium. Now, how confident am I in that? Well, that's reflective of my current allocation. I gave myself a lot of room to wiggle around in there and add to the position if I saw any weakness. I will say that this isn't my favorite year, or has been my favorite year. Well, actually, maybe now it's getting better, but to buy defense contractors. defense contractors, like other sectors, go, in cycles of favor and out of favor and favor and out of favor. I believe one of the greatest years, or not greatest, but a great year to accumulate defense contractors was like 2017. Is that the year? I know General Dynamics went through a longer cycle downward, or longer trough, and then was suddenly given appreciation again. But I don't remember if it was 2017 or 2018. That was like a favored year to acquire defense contractors. But anyways, going back to it. So NOC, love the positioning. L3 Harris, I like where they're trying to pivot. They're trying really strongly to pivot in the right direction. So offering more than just these components and communications technology, et cetera. And also stuff that goes into satellites. But yeah, getting into rockets, propulsion technology, et cetera. That I think is going to be very interesting. And now that Aerojet Rocketdyne is under a larger umbrella and has more, presumably, larger budget to do R&D and greater resources, network, et cetera, I think that's going to be maybe potentially interesting of what they can come up with. So as far as valuation goes, you're getting L3 Harris at a discount to peers, NOC at a slight premium to peers, the whole sector relatively discounted to last year. And if I remember correctly, one of the cheaper ones, again, I don't really want to say cheap is better. And I think the club members requested me to do a podcast episode on what I believe to be the differences of when a company is cheap, right, versus when a company is cheap. What I mean by that is when companies are cheap for a reason versus when they're cheap, genuinely cheap, and they're an opportunity, because that's something sometimes very difficult to distinguish. So Raytheon is an for me. LMT is too big. Well, Raytheon's also huge, and by that notion, yeah. But yeah, Raytheon Technologies, the recent Pratt & Whitney engines debacle is going to cost them roughly $3 billion from what I saw in the headlines. And I think that's not really a long-term issue. It's more of a short-term issue. So good for them. Yeah, defense contractors were out of favor during the Trump because he was peace president and people thought Sanguinius would be closed. Trump is going to confiscate your L3 shares and sacrifice them to McDonald's. Any updates on the REIT that holds all cash, Fabio? Oh, yeah. So no update. Oh, well, I did do an update. This will be the first public update. So the question from Danioli is actually about EQC. EQC is a very uniquely structured REIT. It's pretty much all cash right now. They've liquidated their entire portfolio minus, I think it's like 3 properties. Or is it 6 properties? Some small number of properties. And they're pretty much generating income from interest, and they've been doing special dividends. It's one way they've been, returning capital to shareholders. They've been doing buybacks, but they've been looking for real estate opportunities. My issue with EQC is I almost feel like management might actually be a little bit too scared to do any deal. And I've actually really liked 2023, still like 2023 as the year to accumulate REITs. You can go check out my older videos. Pretty consistent with that thought. So 2023, year of acquiring REITs, and I think some of the members are absolutely sick of me talking about REITs. But I stand by that. And then every year there's like a different, obviously there's a different sector that's out of favor, and there's potential gems in there. So EQC management has discussed, and their earnings calls are so short. They're like super easy to go through. But essentially, they are going to try to find something in the near term, or they're just going to close up shop and distribute the cash back to shareholders, which I'm at this pace, they are pretty much probably going to end up doing that, because I don't really see them doing anything. I think they say they're looking at all sectors. They're looking at industrial, they're looking at office, they're looking at retail, etc. But if they haven't found anything at this point, I mean, I don't know. I really don't know. But that's the update on EQC. They are pretty much trading at just under cash now. I don't really expect that to change. And if they do acquire a portfolio, it's going to be pretty large portfolio, because you got to think that they have $2 some billion in cash plus leverage. Let's say they do a 50% leverage. or sorry, they do 50% on that deal, cash in. Yeah, realistically, yeah, you're looking at on the high end, maybe like a almost $7 billion real estate portfolio when all is said and done. And yeah, would you say DG is a layup now that it's even? There's no such thing as layups. There's no such thing as layups. I am open to any of my investments being mistakes. I have plenty of them. I post the mistakes in the past trades. You can see all the losses. And mistakes happen. But Dollar General could be a mistake. I don't think that right now. So I don't want to be bearish on them. And I'm not bearish on Dollar General. But I just wanted to refrain from calling it a layup. It's a company going through a difficult time. There are genuine risks. There are genuine concerns. And you need to be aware of them going into it. Even at this valuation. Now, the valuation is getting better and better and better, of course, obviously. But that's evident as the price goes down. But the concerns are still there, and the market is not ridiculous in being concerned about those things. So the CapEx that they're making into the business, necessary. I don't have an issue with that. What else, really? I mean, coming out of this, I think Dollar General is going to be a stronger business, and they're going to continue to operate as they have been with newer adaptations that some of their competitors just simply can't afford to do. Now, the difference between them and something like a Five Below is more focused on a strategy of treasure hunting, densely packed areas, so higher urbanization. Dollar General has really dominated that rural, blue collar, similar income brackets, different age targets. Five Below, I think, targets more like younger, but low income still. And then Dollar General is not about the age, it's about the income. And I think they're at about 40,000 some odd US dollars median income. Costco being over six figures. So you have that, and the Dollar General commentary. Again, sorry if I'm repeating myself to you guys because you guys have heard this over and over and over again. Dollar General commentary has been really much on that consumer struggling, and then they can't pass on those costs to the customers. There's a limit. There's so much they can do. So that's something to think about or consider. And if you see a nice drawdown in the blue collar part of the United States, that would, in effect, target or hinder Dollar General's ability to service their customers, or their customers' ability to purchase their products. But that being said, I think that the way management is positioning themselves, as in investing into the downturn, I think is a positive note. And I think coming out of this, they're going to be stronger. But we'll see. And that's the difference in confidence levels of where they're positioned at within the portfolio. My tweets may not make sense to a lot of you because in the personal holdings, my allocation to Dollar General is pretty small. In the holding co, the one that's available again to the members of the club, the allocation at its peak was 6%, so a bit more aggressive. And so in light of that, that's probably a bit too much allocation at that time, given my thesis. So that was what my tweet was addressing. So yeah, that was the one adjustment I would have made if I could go back, just a little bit less aggressiveness on the allocation. Although, that's saying if I did not know what the price action would be, just given the thesis at the time, it should have followed more or less what the personal holdings was allocated to. So, okay, want to talk about certain stock bullish not too long ago, PLC. Yeah, let's talk about that. Fabi, would you say DG is still? Oh, okay, sorry, I already answered that one. By the way, if you want a direct question, just at Capital Mindset, it comes up and it highlights itself to me. So that's how you can get a question right up in my face. All right, so PLC, Parklawn Corporation. So the joke here, I guess that's being talked about, is this was a favorite one, not a favorite, but it's one of the stocks of an individual who we made several bets with. And I think all the bets have now, we'll say, I won't say we've won all the bets, but so far we're winning all the bets. And so this company deals pretty simple. It's deals in funeral homes, a bit on the higher leverage side, if I remember correctly. I prefer something like a Service Corp because I think that Service Corp has managed their capital stack a lot better than something like Parklawn. I think that Service Corp, and they're not the only one. There's also Carriage Services or Carriage Corporation. Both of those are pretty good. American-based. Parklawn does a lot of its business within the United States. Again, it's just mainly how their debt structured or their capital stack structured. A lot more leverage in Parklawn. Service Corp has benefited tremendously from scale. Believe it or not, there's still a lot of consolidation potential in this industry. So it's kind of like a lot of these other investments that we have that are lesser known, that, despite despite there being large players, you have consolidation potential because it's still so heavily fragmented. I don't have the figures exactly in front of me of the funeral service industry, but for my knowledge or for my memory, it's decently fragmented. I don't think it's as fragmented as something like gas stations, but it's within that realm of possibility as one of the catalysts for growth, often cited by these companies. There are some benefits, and by the way, in doing research on this industry, I'll kind of impart with you guys some things that you may or may not know about the funeral service industry. But you have the various ways that they can produce money. I think it's fairly simple. You sell the casket, which is the highest margin. You do cremation services, decent margin. You do the burial services, and then in the burial services, you have what you can do is you can sell the service up front, and that gives the customer a relief from future price increases and whatever happens in the future because they pay for it up front. That's recorded as a liability on the balance sheet for the company in question. Then you also have the maintenance costs that sometimes can be levied depending on the company or et cetera, but can be levied on the family, and that will you charge them to maintain, like cut the grass, et cetera, on the vicinity. And then on top of that, I don't know if you guys knew this, but there is times and ways and certain criteria have to be met where tombs or grave sites are recycled. It sounds terrible to say, but quite literally, they will either move the body. Well, more often than not, they'll move the body or whatever was there, and they'll maybe do a shared grave or something like that. And that will often happen when it's no longer used or visited or taken care of. And then so they can reuse the land for something else. Other ways that they kind of move past this is they build on top of it. They kind of just keep building upwards. So that's if you were wondering, like, oh, what happens when they run out of land? I'm kind of just helping you pass that step. It's not the end of the world when they run out of land. A lot of times, I think a lot of the contract standard is like 100 years. So you rent the land for 100 years. And so after that 100 years, you can re-rent it, or your family, maybe you're not alive by then. By then, you're probably not alive. But your next generation can re-rent the land and keep it there. Or, again, you go through that process. But by then, I don't know exactly what's going to be left down there. But, why aren't we talking about the Fed? Oh, that title is completely a joke. So I like putting those joke titles because oftentimes it kind of keeps the OGs of CM. Because then you guys think it's funny. Alba was in Sin City, though, so that does not fit Robert Rodriguez's thesis. Well, there you go. But yeah, Parklawn, it's down a lot. It's down a lot. Okay, I can't say that doesn't make me raise an eyebrow, but high leverage, rising interest rates, inability to truly pay down the debt. They have to roll forward that debt at a higher interest rate cost. Not a good setup. 5,000 Foot Locker. Now that margins got wrecked. Man, I don't like Foot Locker. Remember the time we invested in Foot Locker, Elemental, because I know you were around the channel back then. That was a trade. I don't often do trades. That was a trade on valuation, just how cheap it got. Oversold, and we sold it pretty soon after. Videos on YouTube, by the way, of me buying and of me selling, and explaining why I bought, why I sold. But it's not something I bother with fully delving into. I know that it's liked on YouTube. I don't know why. Foot Locker is really liked on YouTube. There's a lot of investors who seem to really like this company, and I mean 5-year low right now. Funny enough, I think someone also said this was like a great stock, but you know, we'll leave that alone. Okay, so we do see very AI and very calm penguin. Fabi, did you do a video on ARM or Adyen yet? I haven't been keeping up. So no, I haven't. So Swag Pretty Fake, I know you've been busy. I've been equally as busy. Pretty much all the content I make, I'm time restricted from doing public content. So I'm glad I'm here right now, but I'm time constrained from doing public content. So I haven't done a video on either of those yet. Although I do want to do a video on ARM, and I do want to do a video on Adyen. And I actually want to discuss Adyen a little bit here today. Because Adyen was a company that I knew a lot of people on YouTube too were bullish on the company, and it recently just absolutely got destroyed, wrecked. But yeah, let's talk about Mandy's question here. Mandy asks, any thoughts on the future of retail landscape, especially Target versus Walmart versus Dollar General versus Burlington's, etc.? Great question. Yeah. So you have let's call it the top tier business models, right? You have Costco, right? Costco is shielded from a lot of the woes that a lot of other retailers have been facing. I think it's my Best Buy video. I talk about the change in strategy for retail into the future and how that's going to manifest. So Best Buy was changing the layup of their business model to be more so changing their store layouts to all be kind of mini warehouses. The future is omni-channel for sure. There's going to be an in-person experience mixed with some sort of online experience. And so it's just basically removing barriers and making it easier and easier to acquire the products you want. And they're all going to be focusing on that. Walmart can already do this because their network is really vast. Each of their stores is huge. They operate in mega stores practically. And so their network is set up perfectly for this. Best Buy's trying to get there. Target's set up decently well for this. Dollar General is not competing with them at all. Dollar General is competing against that mom and pop in that small town, and in the food deserts, they're the only ones there. So they're kind of separate, and they're able to put their locations in places that the other guys don't want to put locations in because it's not profitable to set up a large scale location, and that's the realm that Walmart operates in, large scale. Costco, large scale. Target, large scale. There's no mini stores for these companies. Now, how is something like a Best Buy going to compete? Well, Best Buy is trying, and I have relationships with Best Buy for various products because they've done it in a way that made sense for me and for one of my businesses, where the equipment can be done in some form of lease upgrade program that enables you to expense it out on the business, and you can continuously upgrade. And since it's for business, you're probably going to upgrade the product eventually, and so it makes sense. And that's really why they've attracted my business at all. If they didn't have that, I wouldn't actually do that. I just do it on Amazon because of the convenience. It's so convenient to buy things on Amazon, at least for me. And then Walmart, I don't really find myself going to Walmart at all, actually. I don't really use Walmart Plus. Walmart, I will go there out of convenience, out of locational convenience. If it's there, it's nearby, I will go to Walmart. I will actually go to Walmart over Target. The Walmarts that I have experience with, they're fairly nice. There's not really an issue. And the Target, I feel like, you're just going to Target knowing that there's Walmart exists, and you're just willing to pay more because the ambiance, you just like it more. That's how I view Target. But Target's not that expensive. Target's still fairly cheap, by the way. Target is still technically a discount retailer. People kind of call Target Target, but it's not really expensive. It's nothing like a Whole Foods. I mean, Target does not compete with prices on stuff like Publix is way more expensive than Target. Not way more, but it's more expensive. Kroger, I've actually not been in a Kroger in years, so I don't know what the prices are. Have you heard of IDXX bullish on pets and water treatments? Oh, that's one was covered by Strongman. I didn't look at it. Yeah, I didn't look at that company. So I can't give you a solid opinion on it, unfortunately. I'm not letting you wriggle out with the of this. It, quote unquote, it was a trade, quote, Fabio. Oh no, it legitimately was. If you refer to the video entering and selling video of Foot Locker, yeah, it was a trade. Now, because my comment that it's not wiggling out of it, it's just saying I don't have the it's not a ding on you, Elemental, by the way. Could be a great opportunity. I don't have the desire to look into Foot Locker further. It on paper, it looks cheap. Yes, it looks super, super, super cheap. But what are the risks there? And do I care enough to, that sounds bad, but do I care enough to, delve into those risks? And let me just quickly see this right here. Okay, sorry, I'm just responding to some work messages. Okay, there we go. Cool. Being on footwear, thoughts on Crocs? Good question. Oh, and I said there's two questions above you. I want to get to those, not to skip them. So what is your opinion on CCI? Overall opinion on CCI is solid, but I do see that they have some risks going for them. Okay, mainly in the trajectory of how they resolve the small cell issue. Right, it's going to be less profitable on a per unit basis, but I think they're going to overcome that. The valuation, I think, pretty much prices that in. Famous last words. Oh, it fell down enough. It's pricing that in. But all in all, I think that you're kind of paying for that downturn. Unlike you look at American Tower, which is still elevated trading at a premium relative to CCI. CCI has a historically high dividend yield for the company, historically low multiple, low multiple on FFO, on NAV, etc. No matter what way you look at it. But the other component, right, or the other question, sorry, is Enphase. I actually got a question today from a subscriber on the old Enphase video saying, hey, are you going to revisit Enphase? Because Enphase got to the valuation that you said. And Enphase, let me see what not year. I think it was 2021. I just go to my notifications here and I can see the video. Okay, so the video was posted 1 year ago on November 10th, oh no, that's not 1 year ago, YouTube's telling me it's 1 year ago. November 10, 2021. And it was when the channel was super small, only got 292 views. The price of Enphase at the time, because I can see it in the video, was $241.62. And the valuation on Enphase, and this is what I love the comments. So even when you comment and it's an old video, I do read them. I may not get to them, and this time I did comment back because the person was asking, hey, you should do an update. And you're probably watching this video, by the way, the commentator, or you're watching this live stream maybe later. But the, let's say, it brought up, okay, it's now at the valuation you said was interesting or close to it. Will you do an update? I'll probably do an update and reference that older video in my update. I feel like that's fair. And there's a lot of things going well for Enphase. I'll have to have some conversations and discussions with people who know the technology a little bit better than I do, so I can get a better grasp of it, because I was just doing it from a perspective of financial analysis, not necessarily from the full technology aspect. So How are small banks doing? Any sign of recovery? We waiting on the Fed? Carson. No, but I'll answer the question. Okay, so bank commentary in general, they've all been rosy. None of them are saying there's anything wrong. But, we had the video theme 2022 liquidity crunch. I had no idea it would have culminated into like the regional banking crisis. That was still out of left field per se. So the position I think I'm happy with in hindsight, looking back at the story, how we positioned ourselves in 2022, how we positioned ourselves going into 2023. And we lived through, the recent regional banking crisis. Because realistically, looking back, how would I have optimized better? I'm happy how I came out of it with something like an asset like US Bancorp, which honestly, I never thought I'd get it at that valuation. Honestly, I wouldn't even mind owning a little bit more if I take another look at the thesis and the risks aren't that big. But the allocation to something like, Truist, I think, has an average duration of 9-something years. I don't know. Yeah, because I was doing some further analysis on Truist, and it deserves its own video, but the average duration in Truist is still not that high. So the duration risk component, besides the credit risk, that's what the market was so scared of recently. US Bancorp has a really low duration. JP Morgan has a really low duration. And Truist has decently low duration. Something like a Bank of America has a really high duration. I think theirs is in excess of 20 years. So it's not really credit risk, it's duration risk. And so you have a lot of those unrealized losses. I think now everyone understands that for the most part. But yeah, it's just interesting to think about. It's really interesting to think about. I don't know what the rationale necessarily is for the discount, but I'll take another look. What are your thoughts on the impact of spending by Gen Z millennials due to restarting of student? Oh, this was a question asked me the other day in the club, and I don't know what the true impact would be, but surface level thought, it seems like it would do something. All suddenly, you get used to not spending all that much, and then boom, suddenly you're having this expense come in, going off somewhere else. Your discretionary spend might come down now because now your necessity expense has increased. Yeah, it might be an issue. So, Mandy, you're coming out with a good question there. Which sector looks promising for investing in Q3, Q4? Any risk/impact of government shutdown? Oh, well, playing on government shutdown risk. I mean, hey, maybe if you get a panic sell in any company that is dependent on government payouts, that might be an interesting, that hasn't happened yet, but that might be an interesting place to look. And if you can identify it's because of the government shutdown, might be interesting to take a look at, because that would be undeservedly so, the sell-off, because I don't think longer term the United States government is not going to pay its bill. And let me think. I mean, REITs as a sector, if you can kind of find the ones that are nice, they've kind of had their own like mini rotation, because a lot of capital has fled out of REITs in 2022 and 2021. Oh, I should also shout out my video in early 2022. I had a video in early 2022 talking about me selling my REITs, why I sold my REITs. And Realty Income was one of the ones I kind of kept, but severely reduced. And again, the more important part of that video is like why, not just me doing it, but why I'm doing it, the rationale. So shout out to that video. I think it was posted for the month. It was in January. And I think it's a video with Realty Income in it. And the other one was, it was that mall company, the one that Monish Pabrai liked a lot at the time, which I actually think in hindsight or afterwards, it did okay. There was a period it did terribly, and I kind of ragged on him a little bit for it, a little early. I'll get to Crocs. Sorry, Wastopia. So do not feel like bashful to re-ask a question if I accidentally skip it. Seritage, thank you. That's the one, Seritage. But yeah, don't feel bashful to re-ask a question if I skip it. It's not on purpose. But yeah, I'll get to it. Wastopia. And then let me think of another. Yeah, so REITs in general, there's like categories within REITs. Like office was really discounted. I think office is still relatively discounted. But you want to be careful. Fabio purposely skips members' questions. I was going to say aparts from REITs. Okay, there we go. Aparts from REITs. So you eliminate that sector. Banks with like an asterisk of like an asterisk on the banks of a lot of these businesses are black boxes and they might have risks that are very difficult to tell or see. So big asterisk on banks. Industrials. There's certain industrials that on a historical basis look pretty cheap, right? You have, you probably want like some names because you have Honeywell, which is trading up, hasn't really, let me see, but Honeywell, I believe has still held up strong. Let me see. Yeah, 195. Yeah, that's traded up well. You have 3M. There's reasons, okay, for that one. You have Leggett & Platt. That one is definitely like perhaps more of a cyclical downtrend right now. They're really struggling. And I think with that business, they are at risk cutting the dividend at this point, unless they're going to borrow debt. And they have dividend king status right now, so they might lose that. But yeah, you have Honeywell, right, held up well. 3M, litigation risk. You have Leggett & Platt, bed components and all that. You have International Flavors and Fragrances. You have their Swiss competitor, Juvederm. Both of them are relatively discounted. You have the chemical businesses. I think CE has recently been on the rise. I've exited CE, but hey. Okay, no. It's still relatively suppressed. Here you have, though, I'm walking you through the risks, by the way. You should definitely research this further. But I'm trying to give you like the head start a little bit. Celanese, you have that recent acquisition from DD, DuPont de Nemours. And there's debt risk here. You have BASF. That's discounted because of its proximity. It's concentration in Germany, proximity to Russian assets, which I think has already been relatively priced in / resolved. And energy input costs, which is also another risk. So you also want to consider that. Off the top of my head, DuPont de Nemours, I think, is trading relatively elevated, but it has a lot of growthy businesses inside of it. Yes, it is. Okay, remembered. Because I'm going off of memory here, so it's like I have to recheck because I don't want to say something to you that's false. You have Dow. Dow's trading, I think, relatively muted, but slower growing businesses, more legacy businesses, worry about input costs. Same with LYB. Same story here. Same issues as BASF. Energy risk, a little bit less muted than BASF, but still there, still present. Off the top of my head, there were some other smaller sectors that we discussed in the club that were looked at interesting opportunities, like salmon. I'm trying to think of gaming was an opportunity. What? Yeah, you're not looking for was. Tech was. Yeah, you're asking for Q3, Q4. Very. Oh my gosh. Yeah. I say this tongue in cheek, but because man, it's like this is hard to play, but bonds. Yeah, bonds potentially, but like, you're too much work. Honestly, you have certain software businesses. Let me tell you, certain software businesses. Let's say underneath big tech, there are still some that trade relatively cheap. You want some names. This is, by the way, when I'm saying these names, this is not a line in the sand like these are good businesses, you should buy them now, etc. These are just names I'm throwing out there that you might want to like investigate. So underneath big tech software names, Viva Systems, last time I checked, relatively cheap compared to historical levels. Software. I'm not going to say, because Oracle, the cloud service provider, they've all, just been really strong this year. No, there was another one in my head. Well, you have the unprofitable ones. If you want me to throw out unprofitable ones, no, that's different. Yeah, because there's Blackline. There's the payment software solutions you have, and I'm not talking about fintech just yet, but like Paylocity, Paycom, etc. Those recently went through a recent correction. Shout out to you, Andrew. Okay, fine. I'll say Rick. Fine. You happy? I'll say Rick. So small caps. You have some in the small cap space that I cover more extensively in the club. Let me think. I believe that covers most of them. Semiconductors, you have some, depending on where you look, like Qualcomm's arguably cheap. You have some of the specialty semiconductors that arguably are cheap, the ones that are not, connected to AI. Yeah, like there's still opportunities out there. Retail. I literally just forgot about retail. If you're not Walmart, if you're not Costco, you're going through retail Armageddon, Dollar General, Dollar Tree, and them. There's probably more areas that are going through a downturn, stock price wise and business wise, but those are the ones off the top of my head. Okay. Then there was the question that I said I would not forget. Let me find him again. Crocs. All right, let's talk about Crocs. So, Crocs. What I like, what I don't like about Crocs. So Crocs. I like the flexibility of their business. Their supply chain's pretty flexible. Margins, amazing. I hate the Hey Dude acquisition. I participated in a live stream with Bacon Memes and Jesse from Stone Cold Investors, where they effectively pitched the stock to me in an effort to help me understand the business. Why are they bullish, etc. And one of our club members, he's also, I'm joking around here, but he legitimately is, in my eyes, like the Google of Crocs. He just knows everything about Crocs. I ask him a question, he knows exactly about Crocs. Thank you, Frosty. I see your comment. And again, reminder, if I skip your question, it's a complete accident. It's just, have to remember it. But feel free to ask your question again. Thoughts on Ulta? All right. Remember, if I forget it, it's not because it's not personal. Just ask again. But anyways, so Crocs, their margins were so good prior to that Hey Dude acquisition. I don't know why they did it, just for growth's sake. The argument is that management's going to get Hey Dude to a comparable margin structure, whereas the Crocs legacy business, it's funny because that was supposed to be their slower growing. It's still growing pretty fast. And again, the profit profile is amazing. I think they've worsened the business, but management team here, the change was phenomenal. So the new CEO, he essentially comes from a consulting background, but consulting in supply chain logistics, etc. Basically the perfect man for the job. And what he's done with Crocs is quite incredible, quite remarkable. The other management members are also coming from respective backgrounds that relate to the business line of Crocs. So they have the right team in place, and they've been executing really well. I'm really happy with that. I'm not an investor, but I'm really happy with that. My main concern besides the Hey Dude acquisition is I don't like fashion. I just don't. I don't understand it enough. So even if I were to add Crocs here, and by the way, I did make a Crocs video when it was, I think it was like in the 50s. My opinion at the time was, and don't take my word for it, go watch the video, was it's extremely cheap. And my only reservation was I don't know fashion. So should have ignored that. No, because I'll probably make more mistakes. Well, the one time I got involved was like L Brands a little bit on like that beaten down cigarette butt trash play. But that one actually, if I held it, would have maybe worked out depending on the time frame we look at. But who knows what it would have been. I basically broke even, believe maybe a small loss. And aside from that, I didn't really delve into fashion per se, because I just don't understand it. I don't get it as much. But yeah, the hesitation around Crocs around that video, as stated in the video, was I just don't understand fashion, but it was undoubtedly cheap. And now I think if I were to look at it, because I'm trying to go off memory when I did my last analysis, it would look cheap. It would look cheap here. The concerns, again, slowing growth, margins not expanding, margins contracting would be worse. Growth is slowing down the Hey Dude acquisition, which puts into question, they do have an okay amount of debt now. They are paying down the debt, so there's that. It's a different prospects. The leverage was lower before the Hey Dude acquisition. Honestly, like, oh my gosh, at this valuation, I would probably pound the table more enthusiastically if they didn't do the Hey Dude acquisition. I know I listened to the arguments brought forth by the bulls, and I still can't get behind it. I still think that was a mistake. I think they had a perfect business for what it is, and if they focused on having a pristine balance sheet, even building out cash, making the business bulletproof so that it can withstand any downturn, okay. I get it that they want to expand beyond that one-hit wonder product of Crocs and be more than just Crocs so that they can perhaps stand the test of time and be more diversified. I get it. So, but, okay, also the timing maybe, because I probably would like to guess if they waited 1 year for that Hey Dude acquisition, they would have paid a way better price. But hindsight's 2020. Okay, so we do have some other questions that were coming in. And one of them was Estee Lauder and Ulta. I'll answer them both at the same time because they're somewhat related. So Estee Lauder, $152 a share. Let's see what it's down year to date. I think it's down, 40% down year to date, 5% in 5 years. So it's underperforming the market at this point. Always has historically traded at an elevated multiple. You have some of the larger players. I think it's them, and is it L'Oreal? That is the other large player. I think it's L'Oreal. With Estee Lauder, you get the full spectrum of products and makeup. You get low-end, high-end. He, if you think about it, Fabio, is a retail investor. Oh, that's a good joke right there. That's a good joke. Crocs are loved by those who hate fashion. Yeah. Hey, that's another good point. But anyway, so Estee Lauder, pretty good margins overall. Concerns about growth, concerns about margins also. It's kind of present right now, funny enough. And they've been acquiring via acquisitions. A lot of their growth historically in most recent years has been via acquisitions, not a lot of internal growth. And that's fair given the context of the industry. It's a fairly mature industry. You don't really have, oh, sorry, almost forgot the other concern right now. It's travel, funny enough. Estee Lauder is talking about how travel is actually a headwind currently, or the lack thereof, in specifically the Asian markets. So what should bring into question, I think the question isn't, will Estee Lauder survive? The question is, how good can the price get so I can get a good return at a modest amount of growth, more or less in line with global inflation, and you get some growth at the from further acquisitions, et cetera, and assuming that the acquisitions are fairly priced and they're not paying nosebleed prices or empire building. You wouldn't want that either. Assuming all those things, what price can I get Estee Lauder for? And that's, I think, the question here. So is the current price attractive? Short answer, yes. And I've held off on Estee Lauder for a long time. Will I be buying? I don't know, because so for full, context or disclosure, I don't share the dollar amount in, publicly on YouTube, but the holding co as of present practically, and those of you who are club members know how much the monthly contributions are, and so you might be wondering, like, Jesus, how much firepower is there? I'm practically putting all the firepower into that portfolio, and I walk through my thought process, like what I have, and so that being said, so basically, essentially, the personal holdings hasn't really received any fresh contributions. So I'm dealing with legacy capital, essentially. So basically, the recent sales that I did in the portfolio, and I did that with a lot of you members live, because I do value a lot of the opinions of members, and I like to bounce ideas off of you guys. You guys already know that by now, versus how much time we spend hanging out in the voice chat. And so bouncing those ideas off of you, I did sell a lot of those positions and consolidated into, some cash. I do have firepower in the personal, but it's just like Estee Lauder is competing against other ideas. So if I don't buy it, I'm not saying it's a bad investment, it's a bad company. I can hold the opinion that it's promising, but I'm not participating in it. Very similar. And one of the earliest videos I did on this concept, because that happened, was Bristol Myers Squibb. I sold Bristol Myers Squibb in 2021. There was a video about it back when Austin was on the channel. And I wanted to preface that I don't think Bristol Myers Squibb was a bad investment. I just wanted the capital for something else, and that was Cardinal Health. Hindsight, after that video, you looked at what Cardinal Health did and what we sold it for. That was a good move, but Bristol Myers also did decently well from that video. So what I'm trying to say is, I can say it's a good opportunity, but I might not buy it. So on the surface, Estee Lauder looks like it's interesting. That PE, by the way, ignore that. You don't want to use that per se off just face value. You want to look a little bit deeper than that. But I've already done some digging, and so I can tell you with confidence that PE is not perfectly illustrative of the valuation of the business. PE is a fine smell test, but under many contexts, it might be missing context. Okay. Then going into Ulta. So Ulta, I think it's funny because if Dan's probably went to sleep because I'm the degenerate posting this live stream late at night, but the private call we had about Ulta Beauty, this is one that I put them and who was the other one? I think actually it was them and Dollar General discussing both of them together, how there was like that retail Armageddon, and I liked them both at the time. Ulta Beauty ran up and then came right back down. So now it's time to revisit it. Ulta has kind of tapped into a very powerful part of the market. They compete with Sephora, which is owned by LVMH. And if I'm being honest, I think Sephora is a better business and under better business umbrella, but they focus slightly on a different customer base. So Ulta doesn't focus as much as, they do overlap. There is a decent amount of overlap. I don't want to ignore that. And by the way, I'm going off of third-party commentary, if you get what I mean, because I am not a customer myself of these businesses. That's the best I got, and that's sometimes not, I don't really like it. But we'll talk about Disney because Disney was one of the topics today. So yeah, Ulta Beauty, and summarize it. I don't think the retail Armageddon is a permanent issue. I think that's something that they're going to get past. What I have concerns about with Ulta Beauty is their growth capabilities and the near-term effects of that shrinkage. I think that's something like Ulta Beauty, which, for some context, if you listen to Target, or I don't think Target talks about this in their earnings report, but it is not a trade secret that one of the most stolen items at a store is makeup. That shouldn't be a secret to any of you. So what I'm getting at is shrinkage. When shrinkage escalates as an issue, something like Ulta Beauty would get hit one of the hardest. How can they circumnavigate that? I think they're going to find a way. Ulta Beauty is similar to Estee Lauder. It's not a question, I believe, that do they survive? It's, okay, how great of a price can I get it at? And how can I model out their growth going forward? What's their growth potential? I think that something like Ulta Beauty, the growth potential is not muted. I don't want to say it that way, but it's not what it used to be. I think I forget what I had modeled out, so I'm not going to say it now. But I had some rudimentary models set up for this. And going back to valuation, I think right now it's at relatively fair valuation. That's it. Probably you should look at HIMS to help your shrinkage. HIMS is a very popular retail stock. I don't understand HIMS too much. So, are you still interested in investing in UFC, WWE? No. So, Danioli, I think because you're referring to the holding co's small investment, which at this point I forget what the size was. If I go into activity, I'll see what the size is. But it was small enough that it wasn't material. And it was just kind of a watcher position to kind of get my feet wet, get me interested, force me to look at the stock further. What I determined came out of it, not now. Valuation is not there for me. I like the assets. Now's not the time for me. Okay, so the monthly distribution firepower is tree fitty. I'm joking. Okay. Now let's talk about Disney. Disney spending $60 billion. So refer to my Disney video. I outlaid what I believe the company should do. And what Disney announced today is not exactly like word for word, but it is very close to what I said the company should do. So, connecting the dots here, you would presume that I am in agreement with management here. And I am subsequently going to be more positive on the company in the future. And the answer is yes. Because, I mean, it lines up, right? I have a thesis. I say, I think the company should do X. Company does X. And market punishes it. But I am my own person, my own free-thinking person. And I say, oh, okay, well, I thought you should do X. You're doing X. Why would I punish you? Why would I say that that's a bad move? No, it's a great move. I agree with that. And that's what you should all do with your investments. You shouldn't, it's your plan, right? If they're following your plan that you said was a good idea, why would you not do that? And that's a great follow-up question, by the way, adding to the conversation from AJet. You think there will be reforms made with how they handle their IP? I sure hope so. I think, again, the thesis is simple, right? And I said it in the past. It's public on YouTube now. They have great IP. Never a doubt about that. And you guys might wonder, or any new members, any new people who just joining Capital Mindset, might be saying like, hey, you bought Netflix share. It's like, your big media investment. For those of you who weren't watching videos back then of Capital Mindset, I'll spoil it for you, but there was a lot of commentary of why I was wrong to buy Netflix and why I should have bought Disney. My pushback was always, Disney's a very bloated enterprise. There's a lot of lack of CapEx. And that was actually one of the cited issues when I did my analysis on Disney back then, was there was a huge amount of capital expenditure they didn't do in the last decade. And if you frequented the parks, you would notice that. And again, nothing secret. And yeah, them moving forward and announcing this increasing CapEx, I think is a good move. I think that's what should be done. So you know what? Remember how I say I don't like Bob Iger? I'm gonna give points to Bob Iger. I'm going to give points. I feel like I'm an open-minded person. And even though Bob Iger is starting low, he's gaining points here as a manager. And the recent churn in Disney's management, I think, bodes well for the business. But going back to your question, do I think there's going to be reforms made? I think there is a strong potential for reforms to be made. Remember that the IP coming out right now, this was already pre-planned. Okay, so what I mean by that is the content, the writing, the direction, the overall theme, that's all history. The content change is going to be felt in the years to come. So, 1, 2, 3 years from now. So it's going to take some time. I think that Disney needs to really take seriously and be a little bit more cautious with your IP. Slow it down a bit. Star Wars, I think, has they can still recover it despite everything they've done. There's some extreme things that if they did, they would win back the fan base like no tomorrow. Oh my gosh, like no tomorrow. And what I mean is they retcon some movies. They just say they're part of the extended universe now. These are the real movies. If they did that, they would blow up the internet. They would blow up the internet for months. People would be both outraged and happy. But yeah, drive a lot of media attention. I'll be Jabba the Hutt to your princess. Oh my gosh. Yeah. Retcon the sequels. Yeah. No. Like if they did that, a lot of people love it. A lot of people would be super happy with that. There was a, not to kind of get into the weeds here, but even like episode 3, Revenge of the Sith, had a lot of writing flaws. I felt like, George Lucas wasn't at least in the end, he wasn't that talented. He had a great idea. But, like even that last combat or that last fight with Anakin and Obi-Wan, there were great moments. There were certain shots that I think should have been kept because they removed it to truly illustrate that story. And reality, there's one show that if they did, because I call myself a former Star Wars fan, but even this kind of show, if they executed it well, I would have to watch it. Like I haven't even watched the new Ahsoka, even though there's like Vader in it. But if they had a Vader TV show, and if they somehow nailed that, I would even come back and watch, because how could I not, right? But they have to nail it. And given the track record they currently have, are they going to do it? I don't know. Revenge of the Sith did have some good memes. Yeah, no, because also like, how could they write some of the lines in there? There were so many cringe lines, like the scene where Anakin goes like, "You will try," and it's like, what? Who wrote this? It's like, I would say it almost equally, or if not more awkward than Hayden did, because it's just kind of out of place. It's like, that wasn't needed to be said. But then there were some other lines in that fight, like the I guess the way the line like liar was introduced when Padme and he saw Obi-Wan behind. There could have been some improvements. But anyways, I'm getting too into the weeds. Andor was good. Yeah, that's the thing though. They have some good IP, some bad IP. It's a mix. Yeah. I think mainly bad. When is a 24-hour stream? I gotta tell you, 24-hour stream can come when I am removed. Oh, I guess you guys might care to know this. So I will be basically living between several cities, and this will be interesting. I'll have a home base, and it'll be actually quite beneficial because I think my monetary savings will be pretty freaking good when it all comes down to it. But I'll be living essentially between 3 cities. I have to figure out like the best way to travel around it. But what that does come with in the new opportunity is more time. That's one thing, or more flexible time. Let's call it that. It's more flexible time. The Yoda Palpatine fight was fire. Yes, no, that was probably one of the best. Fabio Hinge photos will make fine addition to my folder. Oh my gosh. Attack of the Clones. I don't like sand. Yeah, that was a bad one. Okay, trying to go to one of the next topics. So one of the other topics, I will talk about Adyen and PayPal, which are the 2 that I haven't gotten to yet. Seems like Disney got basically nothing out of the Fox deal. Exactly. Well, that was one of the issues I had with Bob Iger. He's the one who leveraged Disney up that much. Okay, keep that in mind. Never let him get away with that. It's okay. We're still flying half a live stream. Oh, that's good. Yeah, that's good. Okay, Jason, I saw you saying Carvana. Oh, by the way, I just want to shout out Jason here. So Jason's a member of the club, and he was telling me Carvana. I took it too much of as a joke. And I think the new joke within the club is that all of my investments, because the members, they see the portfolio, and it's said tongue in cheek, but it's also technically true, that none of that mattered because it doesn't matter comparing it to anything else. It's all underperformed Carvana. and that's true. And so Jason became like the hero of Carvana because he would legitimately tell me, Carvana, like he's doing now, Carvana. And I would take it as too much of a joke. And yeah, I think Carvana is like one of the best, if not the best stock performer year to date. Definitely one of the best. I don't think it's the best, but it's pretty crazy. Because it went from a bankruptcy concern to non-bankruptcy concern, it seems. So yeah, shout out to you, Jason. Okay, but yeah, going back to PayPal and Adyen, right? Why am I bringing them both up? So I haven't done a public, there's so many public updates to PayPal at this point because PayPal is heavily requested, okay? If we're getting right down to the weeds, why do I have a decent amount of PayPal updates? It's because it's heavily requested. It was requested just yesterday, actually. Yesterday, someone was asking me about PayPal again. And it's because the analysis that I provided to the club members, and it's public on YouTube, is valuation under 70s, fairly attractive, given the growth. And by the way, that analysis was done while PayPal was at elevated prices. So don't believe me, there's something called YouTube. And so a lot of YouTube channels, YouTubers, had analysis with PayPal price targets of 300, 200 something, people buying it up in the 120s, etc. And when I did the analysis, it was 70 and below. It got to under 70. We did that small trade with PayPal, but for the most part, we didn't stay in it too long because, frankly, there's a lot of concerns, difficulty about PayPal. Still cheap, still doing its thing. Let's say. Let's talk about the concerns. Concerns with PayPal extend but are not limited to. There's more than this. The user growth declined, and actually active users declined. Now that's not an issue. So when I took a look at it, the user growth decline or the user decline occurred because the PayPal's strategic shift, this is according to management, was to focus on the more profitable consumers. So a lot of those losses were on the unprofitable consumers that were there for a quick deal, right? A quick promotion, so promotional offerings. And very similar to the pitch for Sprouts Farmers Market, where they had the couponing strategy. And by the way, if you're doing a business class in business school, one of the classes you take marketing, you'll learn about case studies. Or maybe in your MBA, you'll learn about case studies about discounted marketing and why that's a problem and why you want to be very careful with that. And maybe in your industry it makes sense, maybe in that industry it doesn't make sense. It really does depend. But promotion marketing can be a detriment. So they remove that. Promotion marketing, comes down. Then you lose a lot of those users. But do you really care? Because those aren't the users you're making tons of money on. Then you have the take rate. So the take rate concerns, that's something. Okay, well, what's the caveat to the take rate coming down? Well, if you take a look at the business lines, you have Braintree. Braintree is increasing. And the, let's call it branded checkout, which is PayPal's legacy business, that has a higher take rate, has higher margins, higher profitability. Braintree, lower take rate, lower profitability as a business segment. So you take both of those together, and what do you get? Well, Braintree's growing fast, legacy's stagnant. Okay, what are you expecting to measure on the other side of things? Simple math, take rate overall should come down as the average is going to be affected in a greater proportion by Braintree. Makes sense. So not that much of a concern. Okay, other concern. FedNow, other government-funded rail networks for payments, instantaneous transfers and the like. How is that working? Well, on the surface, I don't really see what the issue is necessarily. I get there are ways and aspects like that does compete with Braintree, Stripe, et cetera, and Adyen. But a lot of what the branding side of things with PayPal, I don't really see it affecting their legacy business all too much, because that's a product geared on trust. Like, you're using PayPal to protect you. Very similar to how, like, that wouldn't even affect Amex whatsoever. I mean, that would make Amex's business better. And in fact, I think now what, and more often than not, you can consider, well, PayPal is, as a business, not a rule of thumb, but has people who are hyper-focused on this industry. You would think that they'd have people employed that are seeing this happening and are making the shifts necessary, adapting the business, et cetera. Well, they are. A business like American Express wouldn't even care about this, because American Express's relationship with myself and other customers is one built on trust, on convenience, on usage, where I use the product to purchase other products, right, as the customer, and I use them as a vehicle to do so. I get rewards in return, and they protect me from fraud, from all these other things. And so, like a FedNow system, that doesn't really change that relationship per se. That's just, perhaps maybe they can utilize it to make transferring capital much faster. But as far as that relationship between me and the payment provider, the bank, doesn't really change it. Now, something like PayPal also doesn't really change their legacy business. Where I have the question I'm still investigating is Braintree, and speaking of, Adyen. All right, so Adyen is the other business that, if we talk about here, has outright collapsed. Okay, so we had a price of about 1,596 euro dollars. I said that to trigger you Europeans, because everything is dollars. And no, I'm just kidding. But no, in all seriousness. So, well, yeah, what was that? 61%? Yeah, 61% decline relative recent peak to trough. And then recently from total peak, let's take that one, it's down 76%. PE ratio, kind of ignore that from Google, but you're looking at a market cap of about 20 billion. At one point, this thing was, I think, over 100 billion, which is kind of crazy to think about. But they compete with Stripe and Braintree. Block SQ has better opportunity compared to PayPal. Oh, great question, Classic Heroes. Roger, we're not talking about that company, although I love that company. I'll talk about them a little bit just for you. But we'll get to the block question, because that's a good question. So Adyen, what they have, I'm kind of concerned about Adyen. As far as seeing what Braintree and Stripe are doing, I have a strong, or not a strong, but an okay familiarity with Stripe for various reasons. And the Stripe, both from a company level, they've been doing pretty well, even though their private valuation has come down. Won't get too much into that because it's not really relevant to this discussion. But the business as a whole, I'll just say, to keep it brief and within the context of the discussion, has been okay. Adyen has not, from what it seems. The growth is slowing down, and it was priced for extreme growth. And then you do have Braintree coming in and actually still growing strong, attached to a company that has a much lower valuation, although Braintree still is not, the lion's share of the business. And you do have, again, other concerns kind of festering now, FedNow, the various government systems around the world, which, even if they don't have an actual monetary or company effect, there's perception. Perception can play a huge role in these businesses. It can affect the way these companies are priced, because sentiment shift happens all the time. So my main concern with Adyen is, frankly, what others have concerns with, which is competition. And how strong is that competition going to be? Adyen, as far as products go, from my understanding of others, having brief conversations, it's, fairly good, fairly comparable, and efficient. And they've invested heavily. They're hyper-focused. I would argue that Stripe and this is not even my own opinion, this is others as well, share this opinion, Stripe is the superior product right now on the market, better than Braintree, better than just everyone, the most customizable to pretty much any business you can think of. You can't invest in Stripe right now because it's private, but maybe one day it's going to go public, and I'd argue that's probably going to be, it's probably going to be the most expensive of the three, for sure. But you know, I would say is if you're comparing them both as an investment, PayPal's a way better setup. You have a legacy business that people don't really care about anymore. And then you have Braintree, the exciting business that, when I say exciting in air quotes, because they were exciting, all these businesses, and now they're all hated. So Adyen's hated, Braintree is probably doesn't give PayPal any benefit to the valuation. And I'd argue Stripe right now, if it was publicly traded, also be in like some form of trough. This is also a business sector or slew of businesses that it's all a race to the bottom. You're always trying to figure out how to cut costs on your customer because barrier or switching costs aren't that high. They're annoying, so I wouldn't say they're zero. And actually, probably if I'm in a larger enterprise, it'd be pretty annoying. But if you're talking about take rate, and a take rate percent difference is like 100 basis points, that's significant enough probably to cause a change. Because a take rate on your whole revenue stream, you can save, 50 basis points. It's significant. That's significant. You consider that, if your revenue run rate's like that of Uber, yeah, that's something. Payment technology is getting very interesting, where we're probably going to be moving in the direction, and you've probably been noticing this because various tech companies, fintech companies, have been offering over time more rapid transactions. What I mean by that is you can start to receive payments sooner rather than later. So you can, for Stripe, I'll give you an example. Stripe collects payments and can have it into the business checking account within the day, right? Which is crazy. So you can basically pay it out. YouTube pays out on a monthly basis, which is fairly archaic. A lot of companies do that. I don't think that's going to change, because in the case of YouTube, and Discord does as well, that allows them to make money off of your money. Classic, right? So some business models that we've covered in the past, or have discussed in the past, both public and private and content, we've discussed how some of these businesses, they are almost like banks in some ways, where they'll hold your cash for a period of time, generate some return on it, then deliver it to you. YouTube, where it has the leverage over the customer. And I don't know if you guys have thought about this before, but maybe now it'll make sense. There's not really an incentive for YouTube to do that, to make it more convenient, because perfectly capable of doing that. They are perfectly capable of getting you the ad revenue, for example, that day or the next day or that week, very least that week. Perfectly capable of doing that. Why would they? So as an investor in Alphabet, and because I don't make really any money on YouTube, so I don't really have any skin in the game besides to the benefit of Alphabet, they could elect to still pay you out in a month's time. And as that time progresses, those 30 days happen, we can generate some income off of that money, put it in some very short-term duration debt instruments, and collect some interest. And you do that over the course of the broader YouTube space. Hey, it adds up. It does add up over time. So not fairly uncommon by any stretch, but what a lot of these other companies can enable is for various employers to employee relationships, to get that money faster, and that is the benefit. Okay, and as long as they have those gas fees appropriate, shouldn't be too much of a problem. Okay, so and that goes for something like an Uber. Would you say Block SQ is better opportunity to compare to PayPal, Fiserv, and other fintech payment services? So I had this discussion, exact conversation in the club. I think it was over a month ago now. So I think it's fair to say it publicly here. And I don't know if you are in the club Classic Heroes, but so we are getting better. We're going to start actually recording the spontaneous conversations, because the spontaneous conversations are really good. But one of these was discussed. This was discussed in one of those spontaneous conversations. And what I concluded out of that conversation was essentially, well, Block has a lot to prove. They have one main product that's amazing, the legacy POS systems, and they have Cash App. Cash App they have yet to fully monetize. There's a lot of potential there, but that's all it is. And funny enough, so I was at a place, and I already knew this, so the younger people, say in our society, Cash App is more popular. Venmo is, I think it's for older people now. But it's funny because I don't really use Cash App. And so I was at a bar the other day. And then there was, long story short, there was a dramatic incident where the bartender was having a very stressful time. And I felt bad for the bartender. And so I asked them, hey, because I know how the tipping thing works. It will spread it out. And I'll just say, to keep it relatively brief and vague, the issue was caused by two of the other bartenders having a conflict. And then so a lot of the work was placed on this one bartender. And so they were vividly stressed. I'm a pretty calm person in real life. I don't know if you can not tell that. So there were some also customers or patrons that were getting very aggressive for seemingly no reason. And a lot of them were taking their anger out from the other two bartenders onto this bartender. And I felt like that was also unfair. So long story short, I asked the bartender, I said, hey, what's your Venmo? I asked, and I can give you a direct tip because, your coworkers over there, I don't know if they deserve the tip per se. And you're over here, dying. So then they said to me, oh, I don't have Venmo, I have Cash App. I was like, oh. So this made me think of that. And then, so I was forced to use Cash App. So I think it's interesting to observe the demographic differences in who uses Venmo, who uses Cash App, etc. Cash App, what they also have that I think is very, very interesting compared to Venmo is you can invest in stocks, which is interesting. And everything else is, I think, relatively the same. Oh, well, I think this is a difference, but you can't really attach a credit card to Cash App. If you can, I didn't figure it out in the brief time. You had to basically do an instantaneous transfer. But that's about it. Oh, and then there's also Zelle, which I prefer paying out through Zelle, but that's just me. So very quick, what is the actual plan to monetize Cash App though? That was okay. No, that's the point, right? Sam, gosh darn your comment. What is the actual plan to monetize Cash App though? Johan, we're in the same boat. Yeah, that's my point. That's my point. What's the plan to monetize Cash App besides profiting off of instant transfers? I mean, you can build out banking relationships with them in theory, right? You have them having their checking account with Cash App, and then you can offer savings. You can monetize it in a way that, okay, idle cash, you invested in short-term durations, debt securities, generate some return there. You could monetize it. Well, you don't do commissions, but on transaction fees for crypto, that's one way. Offering other products, loan products, etc. That's one way. There's a couple ways, but yeah, add in crazy money, add in crazy amount of ad bro, buy VIP so as free, ad free. Okay. Yeah, but that was the end conclusion, and they're still in like a race to the bottom. But yeah, all right. I will say, given the time, I enjoyed this live stream. I hope to have more time to do more of these in the future. I know that's the time is like very inconvenient for a lot of you, but overall, we had fun anyways. So with that being said, guys, barring any other last minute questions, I think this is where we'll cut it off. And yeah, for those of you who liked the video, feel free to like it. If you feel the need to share it with someone, go ahead and do that. But yeah, go ahead and like the video if you did like it. And crypto solves this. Oh, that's funny. You talked about WPC. Yes, we did. Jason, yes, we did. All right. With that being said, guys, thank you guys so much for watching. And I'll leave you guys out with the outro.
We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.